respondents. The Dallas Fed took a survey, and the message from the respondents is recession is coming, and the Fed is, quote unquote, going too crazy. People aren't liking what the Fed is doing, according to the Zero Hedge article. Hey everybody, this is Rob Kientz for the weekly market wrap-up. We're releasing this one a little bit later than we do in typical weeks because of the Thanksgiving holiday. We didn't have as much report on at the end of last week, but I do think we have a lot of juicy news for you today. So I'm going to go through the economic calendar like we always do. We're going to talk about the movement in gold and silver, both in the U.S. and worldwide markets. And then I've got a couple of stories for you on crypto I think you guys will find interesting. Right now, we have gold trading down $7.84, and this is being recorded about noon on Monday, November 28, 2022. So gold is down to 1743, silver is down to 2103. Gold moving down about 0.5%, silver down about 1% today. A lot going on in the markets right now. The Dow is trading down 354 points, down a percentage point. The S&P is down 44 points, which is down a percentage point. The Nasdaq is down 112 points, which is down a percentage point. And the Russell is down 1780, down 0.95 of a percentage point. So all four major markets in the U.S. down by about a percentage. That is very obviously algorithmic trading all of the markets at the same time. We've got some different concerns going on across the world, according to CNBC. A lot of this is going on because of the protests against COVID controls in China. That's on the front page of CNBC. And so that apparently is weighing on the market as well as what's going on in the crypto space. We'll get to that here in just a moment. I wanted to go over what were the big economic releases for last week. Most of those came out on Wednesday. On Monday and Tuesday, we just had some of the Fed, the bankers basically commenting. We had San Francisco Fed President Mary Daly speaking on Monday. On Tuesday, it was Kansas City Fed President Esther George. But most of the actual data, economic data, came out on Wednesday. So durable goods orders, which is a positive sign for the economy when it's up, because it means people are buying durable goods, things for the household, things for everyday life, was up a full percentage point. That was double economists' expectations of a 0.5 percentage point, and more than last month of being up 0.3%. So good to see that some orders were there. It means somebody in the economy is ordering something. Core equipment, capital equipment orders up 0.7% after last month dropping 0.8%. That also is up. So some areas of the economy doing okay at the moment. Initial jobless claims and continuing jobless claims, however, were higher. Initial jobless claims were 240,000 on expectations of 225. Last month, 223. Continuing jobless claims at 1.55 million. No economist expectation there, but last month it was 1.5. So more on the jobless claims, and that makes sense because we've had the tech sector laying off workers. Amazon announced it would lay off 10,000 workers. Lots of other companies are talking about doing this as well. Disney right now today saying that they will maintain their hiring freeze in place. So it's not just the tech sector that is under pressure. It is the entertainment sector as well. S&P U.S. manufacturing PMI was under 50, which means it's contracting. It printed at 47.6. Economists expected an even print of 50.0. They didn't get it, and last month's print was 50.4. So we're definitely contracting in terms of U.S.-based manufacturing. What about U.S.-based service? We're primarily a service-based economy. That's most of the economy. How did we do there? We were under 50 as well, which means we are contracting. We had a print of 46.1 for the previous month. On expectations of 48, we didn't meet expectations, and last month we had 47.8. We definitely did not match last month either. The Consumer Sentiment Index from University of Michigan is at 56.8, which is higher than expected. That is good. And the University of Michigan 5-year inflation expectations was at 3%, which is exactly as predicted. New home sales, 632,000, much higher than to be expected of 570,000. So a couple of green shoots there in the economy, although it looks like manufacturing and overall growth is coming down headed into the fourth quarter. This week, we will get more economic news reports. Today, we will have St. Louis Fed President James Bullard speaking, as well as New York Fed President John Williams. We'll look for those releases and see if there's anything of significance. We also have the U.S. Home Price Index, both S&P and FHFA, the Consumer Confidence Index, and we'll get the employment reports, the ADP employment report, as well as, since this will be the first Friday in the month, we will get on Friday, we will get the non-farm payrolls as well. And a lot of manufacturing disposable income type of information is coming. So not too long before we get that. I wanted to turn to the news of the day, or the news of the week, before we get to the gold and silver report, which we'll end up the presentation on. The big news is crypto firm BlockFi files for bankruptcy as FTX fallout spreads. Crypto firm, a lending firm, BlockFi, filed for Chapter 11 bankruptcy protection in the wake of FTX's bankruptcy. It's the latest in a series of crypto bankruptcies following FTX, Voyager, and Celsius. I'm reading from the front page of CNBC. This story just came out as I was setting up for the recording. It says here, distressed crypto firm BlockFi has filed for Chapter 11C bankruptcy protection in the United States Bankruptcy Court for the District of New Jersey following the implosion of putative acquirer FTX. In the filing, the company indicated more than 100,000 creditors with liabilities and assets ranging from $1 billion to $10 billion. In the filing, the company listed an outstanding $275 million loan to FTX US, the American arm of Sam Bankman-Fried's now bankrupt empire. Like FTX, BlockFi also has a Bahamian subsidiary. That subsidiary moved for bankruptcy in the Bahamas. BlockFi's bankruptcy filing shows company's largest disclosed client has a balance of $28 million. And it looks like, as you go on to read the story, FTX had tried to swoop in and bail out BlockFi earlier in the year, was not able to do it. And it looks like with the additional problems that FTX is happening, and BlockFi had, I think, a $400 million credit facility with them, and also had some of their holdings on the books. This is basically just taken out BlockFi. Not great. Also, we had an interesting comment from the Dallas Fed respondents. The Dallas Fed took a survey, and the message from the respondents is recession is coming, and the Fed is, quote unquote, going too crazy. People aren't liking what the Fed is doing, according to the Zero Hedge article. While the headline Dallas Fed manufacturing survey did not weaken as much as expected, the production index, a key measure of state manufacturing conditions, fell 5 points to near zero, its weakest level since the COVID lockdowns in 2020. Under the hood, several other measures of manufacturing activity indicated contraction this month. This seems to agree with the S&P measures for both the service-based manufacturing economy I just told you about, which are under 50. New orders index plummeted to negative 20.9 as a 6th month in a row negative territory and lowest reading since May of 2020. The growth rate of orders index dropped 7 points to negative 19.9. Additionally, perceptions of broader business conditions continue to worsen in November. The general business activity index posted a 7th consecutive negative reading, but moved up 5 points to negative 14.4. The company outlook index pushed down further from negative 9.1 to negative 15.2. However, in the Dallas Fed Manufacturing Index, it was the comments from respondents that offer the most prescient insight into U.S. economic conditions. I'm quoting from Zero Hedge. Customers are liquid was a quote. Demand is there. There's just no cash to buy food. There is increased tension in terms of demand for skilled workers and retaining them. Business is slow and slowing. From a paper manufacturing, our outlook in January is hopeful. From a printing and related support activities business, there is less panic buying going on. Inventories are beginning to go down. Lead times are able to give to our consumers are beginning to decrease. We're beginning to see the end of the dislocations caused by the pandemic. Primary metal manufacturing says recession is coming. We're just waiting for the backlog to evaporate. Then the layoffs start. Machinery manufacturing business commented, we are very concerned about the volume of future business activity. We see our customers pulling back their plans for expansion, but still planning for the future. This has put us in a position to be very competitive to win every order possible. Another machinery manufacturing. We're still running strong. However, we believe that inevitable the economy will contract within the next 6 months. From an electronic product manufacturing and computer manufacturing, his is their comment on the report. The Federal Reserve is going too crazy. That is really affecting the industrial equipment industry, installing infrastructure spending as I've never seen before. Millions of jobs are at risk in manufacturing. Again, this is from the Dallas U.S. Economic Fed Outlook report, and these are company respondents and their comments. From a computer electronic product manufacturing, The cost of capital is unbearable for small businesses and will delay or reduce expenditures or hiring unless businesses drive change. From a transportation equipment manufacturing, the outlook is troubling and unsettling. Caution is the strategy. The Federal Reserve is too aggressive. Some comments in there about the Federal Reserve, some comments about costing, some comments about employees and everything. Lastly, we have a story about the diesel crunch is finally causing demand destruction. And from the file of what causes a cure, what's the cure for high prices? Well, it's high prices. We're having demand destruction in diesel, and so prices eventually will have to come down as people buy less. It says here from Tanya Paraskova of oilprice.com says, high prices seem to have started to weigh on diesel demand in the United States, where distillate inventories comprising diesel and heating oil have been slowly rising over the past few weeks. And product supplied, a proxy of implied demand, distillate fuel products supplied averaged 4 million barrel per day over the past 4 weeks, down by 3.5% from the same period last year. So up this year, still down from last year, meaning people are using less diesel this year, which is another sign of economic slowdown because diesel is used where? In trucking and also in services. As of November 21st, the average retail diesel price in the United States was $5.23 per gallon, or $1.509 higher than this time last year. To compare, the average gasoline price in the U.S. on the same day was 25 cents per gallon higher than a year ago. Diesel is getting hit harder than gas. A total of 47 of the 50 states are seeing average diesel prices drop from their week ago levels, with diesel prices down over 10 cents a gallon. In 19 states, Patrick Dahan, head of petroleum analysis at GasBuddy, said on Wednesday, GasBuddy is an app that tracks gas and diesel prices. So some potentially positive news on the diesel front is coming down, but that's because people aren't buying it because we're probably in some sort of recession. And so the higher prices are causing the cure for higher prices, which is less actual transport and economic activity. That was a very long report I gave you on what's going on in the economy because I thought we had such good data come out last week. Even on a short week, I really wanted to spend a lot of time on it and wanted to highlight why the overall economic conditions are not as bullish given what's going on in the crypto space and the apparent headwinds we have on a potential recession. Also wanted to go over the markets. I did read over the stock markets at the beginning. The bond markets are basically the same. Not a lot of change last week. Everything shorter term than the 10-year is in Treasury yield curve inversion with the 10-year, including the 2-year. 2 and 10-year is the benchmark Treasury yield curve inversion, but the 1 month, 3 month, 6 month, 1 year, 2 year, 3 year, 5 and 7 year are also all trading at higher rates than the 10-year. What that means is people expect across the board from today up to 10 years there to be more risk than there is 10 years from now, which is why they're demanding higher rates. This has always been a sign of a recession coming. I think that's going to continue. And then overall in the crypto market, of course, crypto is being slammed. Today, Bitcoin is trading down 401 points at time of this reading to 16,149. Ethereum is trading down 43 points to be at 1169.65. And overall, there's red across the crypto complex almost everywhere. The USD coin is trading up 1 cent. That's the only green I see on the chart. Hard few weeks to be in the crypto business. We'll have to see if that comes back and recovers. I'm going to share a screen, and real quickly, we're going to go over the gold and silver data. Not a lot on a short week here. Usually on Thanksgiving Day week, it's not too exciting. Here we are at the CME's group. I always start off on volume and open eye. We're going to look at that open interest. It's down as to be expected leading up to the holiday. Not a big change overall. The heavy trading is now moved to the February contract. At close, open interest was 327,000, whereas you only had 59,000 for December. So people are already rolling their bets into February on gold. It'll be in March on silver, which we'll see here in just a moment. Looking at exchange for physical, that is the trade hunting for physical or price arbitrage between the U.S. and London. That was 1,700. That's a fairly big amount. People are actively looking for metal on the markets. This is what this is an indication of, and they'll trade their position on COMEX for London to get access to that metal. And this is interesting to see. These are up. Of course, that is the latest day's data. If we go back, that's Friday, November. If we go back to Wednesday, we had even more EFPs at 2279. Again, a fair amount of trade on December contract, 78,000 contracts, but it's all moved to February, 214,000. Let's get to settlements. This is where we get the price data. As of Friday's data, we were up $8.40 on the December contract. And on the February contract as well, there's trading about the same. December had more trade because it's moving out. People are moving and rolling off open interest from December and into February on gold. That's why you see so many contracts closing, and it did close up for the day as that happens. That was Friday's data. If we go back and look at Wednesday's data, the last trading day before Thanksgiving, we were up also $5.70. And again, most of the trading on December is a roll into February. You can see this 168,000 volume there, 292 here. People are both moving contracts from December to February in gold. They're also establishing new positions. No big information there on gold. We want to move over to look at gold in London. So on this chart, Nick Laird's gold charts are us. Here's the COMEX data. I go over this briefly. It's the same data on a longer time frame, a 4-week change here, down 1.2 million ounces in gold being taken off across COMEX. All the rest of this, most of this is in the UK market, some of it in the US and other markets. This is the ETFs. And in particular, we look at the GLD for gold because it's the biggest one. It has the most money in it. You can see here at $56 billion in total value. And it was down 424,000 ounces overall. They were down about 900,000 ounces over the last 4 weeks. And if we look at GLD, there's been a precipitous decline in gold ounces held in that fund dating back to Silver Squeeze, because I think people are taking physical, not only in silver, ladies and gentlemen, also in gold. As we go over to the silver overview on CME Group, and we look at volume and open interest, we can see that March is a dominant contract here, 96,000 open interest at the time of Friday's reporting, only 19,000 on the December contract. That means people are largely closing their bets for December, moving to March in silver. The EFP for silver was a healthy 506 contracts from Friday. If we go back and look at Wednesday's data before Thanksgiving, we had EFP at 350 contracts. And again, a lot of nice rotation into this March contract off of December. So you know where we're trading. A healthy amount of open interest to end the week. Nothing too big. Let's look at where the prices closed. This is Friday's data. We closed up Friday about 63 cents, both on the December and on the March contracts. I'm sorry, March is up 83 cents, which is positive for silver. It means going forward, people expect higher silver prices because this contract closed up higher than that one. So that makes sense, about 20 cents higher. Expectations for silver to rise from December to March, according to futures traders and their positions. Now, that was Friday's trade. What happened on Wednesday, as we look at Wednesday, it closed up about 31 cents on December and 29 cents on March. Not quite as much enthusiasm for March silver prices on Wednesday's trading data. Looking over to the other markets, again, we look at COMEX, about 4.2 million ounces of silver over the last 4 weeks. Net has come off completely off of COMEX, and eligible has been down almost 4 million ounces and registered down about 356,000 ounces. So eligible is the private storage. People are taking their silver stored in COMEX off the vaults because they need it. I'm suspecting a lot of this is not necessarily for investment, although it could be. A lot of this is industrial demand. We have supply shortages. And again, Silver Institute's interim report came out again, and we expect to continue to have supply shortages in silver every year from what is produced from the mines versus what the market has to supply. And that means a lot of silver has to come off of a lot of these exchanges. And that's why you see red here. Overall down 5.7 million ounces, which means an additional 1.5 million ounces in the last 4 weeks came off of the London market. And if we look at SLV down here, again, since Silver Squeeze, a precipitous decline in the amount of silver held in London. It's being run off. And again, if you look at the London Vault holding data straight from the LBMA's website, you see the same thing. We reported the same number as reported, I believe, once a month. They're down 20 million ounces month to month. And I want to go over the China data. China's new report is out. I'm one of the few people that does report on China as such an important market. This is October 22 report, and I'm going to give you a few things to look at. We're going to go past this, and we're going to look at the total amount in both in weight, this is in kilograms, of the precious metals, including platinum and palladium. And we're going to look at the total amount in contracts at 10,000 renminbi. So as you look at the overall weight of metal, it's down. Less is being traded on Shanghai month to month. Month over month, present month accumulated total, down about 32.9% on the metals. The silver down 40% in gold, and platinum is down 48%. Overall down about 34%. And year on year in China, 72% less trade. 72% less trade year over year this year from last, down 7.5% in gold, 75% in silver, and 6.1% in platinum. And in terms of dollar terms, those numbers are lower, meaning as the prices have gone up, there's been less overall physical trade, but the prices going up have reduced the amount of dollar decline. But Shanghai is delivering less and trading less. I love these two charts because they really tell us a lot. This is delivery volume in kilograms, and this is what's actually delivered on a contract. And you can see here, present month on gold, it delivered 77.9, or I'm sorry, 0.8% of the contracts were physically delivered. In silver, 20.37%. That's the present month. But look at the withdrawal volume delivery ratio, cumulative total, sorry, 72% for the year and 10 for gold and 10% for silver. Both of those numbers have moved up. What does this mean? More people are taking physical delivery off of the China trade, even though you have less overall contracts. Let's go back up and talk about that. Less contracts, all the overall trade on China is down, but more metal is actually being removed. You can see that in the withdrawal volume and in the delivery ratio. Delivery ratios are up, meaning more contracts are being stood for delivery. The present month double what the yearly average is. The yearly average, 10.53% of contracts in Shanghai are delivered. The last month, 20.37, double. People are taking the metal off. It's not only London, US, it's happening in Shanghai. What about gold? Gold, this last month, they delivered almost 78%. When they averaged delivering about 73%. And you can see the withdrawal volumes have gone up here on gold and silver in the Chinese market. The cumulative total in silver is 1.5 million kilograms of silver have been taken off this year on the Shanghai market, and in gold, 1.3 million kilograms. This is a lot, and this is important information. Also, according to the Chinese market, there is a difference of $45.40 for spot gold between COMEX and Asia market. In Asia, you get a higher price for your gold. Why? Because they value it more, and they're taking more as a percentage off of the markets in the Chinese Shanghai. So right now, it appears very clearly gold and silver are flowing both west to east because more deliveries in Shanghai as a percentage. And so we believe the gold and silver are moving that way. We also believe that volumes of metal being taken off of most of the worldwide exchanges is accelerating in silver, but now also in gold as people move to take their physical positions. And I think it's very clear that we have strong bullion sales both for industrial and retail purposes. I think the slide in markets that we've had this year across the markets, the increases in the bond rates and the fears of recession, the aggressive Fed policy and the complaints, the negative comments coming from businesses we saw in the Dallas Fed survey, the declining economic fundamentals that we've been talking about for the last few weeks have led people to consider where they need to go in the next recession and take positions accordingly. And I think we're seeing that shift in the market. And I think people are moving back to precious metals. They're dealing with the crypto fallout. They're dealing with the bond rates. They're dealing with the lack of free income from the consumer part of the economy. 72%, sorry, the economy is consumer driven. There's a big repositioning going on heading into the end of the year. Everybody's trying to guess what's going to happen next year, and they're going to safe assets and they're going to liquid assets, and they're spending less. So it does appear that GDP prints should go down in ensuing quarters, and we're probably officially coming into the recession, even though we've probably been there for a while. That's the picture coming off of Thanksgiving. I hope you guys had a wonderful Thanksgiving break. We will do another one of these next Sunday at a regularly scheduled time, releasing them on both channels, Gold, Silver Pros, and JM Bullion. Thank you guys for staying tuned to this presentation, and we will see you for our regularly scheduled content throughout the week.